Test, test, test. Hello, everyone. Welcome back to the RationalInvestor.co. I had actually a couple requests here just recently for me to do a video explanation of another one of our popular setups, the Hollywood Nick. In here we have a video explanation of the bot, which I think kind of helps people understand how it works. So I thought, and it's a popular setup that I've known for years and years and years. I thought maybe I'd take the opportunity and just verbally walk you through how this trade setup works. We have both on here. And keep in mind, on the site, I mean, there really is no sort of trademark to any of these trade ideas. If anything, what I like to do as an educator, and I sort of learned this years and years and years ago, is, yeah, actually it's easier to remember for us humans if we put outlandish names, outlandish, motions, concepts, ideas to ideas that we're trying to memorize. It actually makes it easier for our brain to remember things. And so what I actually like to do on the site to try and help you guys is give really outlandish, crazy names and ideas, crazy names to ideas, to trading concepts, in an effort to try and help your brain actually connect the dots. A lot of the process that I go through in identifying setups actually is extremely similar. But as you can see here, this setup in particular, I've named it the Tangonator, and it's fun because it was just basically a student who's from Latin America, South America, obviously has a Spanish inkling. It was a fun way for me to connect it with him. And I think it resonated well with him. I sure hope so. It would be a shame if it didn't. This same idea resonated with a student that I had a few years ago. And at that point, we gave the name to him. And he just happened to be from California, LA, Hollywood. So hence the name of Hollywood Nick. But in essence, these are basically the same idea, just from a different perspective. And I've got three sort of examples here. So, hopefully collectively through the three examples, you can sort of see this video tutorial hopefully will give you sort of a walkthrough, a demonstration of what is that trade process that Brian's always talking about. I think if anything, what might be an idea is we'll just lay them side by side by side. Hopefully what you guys see, the very first thing that you see that jumps out of all of these images is there's been a substantial move in one direction or another, right, in price. And that's really what the basis, in fact, I used to, in this case, quite a drop down to here. I used to work with a professional, and he would say, actually, the worst thing that could possibly happen to quote-unquote traders, guys who want to make money from trading, is no volatility. What we need is volatility. That's really our bread and butter. And you could argue that that's really what this setup is all about. It's just taking advantage of volatility and the statistical relationship price must obey, but with the injection of volatility, how we can take advantage of it. I mean, it's just that simple. So the very first thing that should come to mind is, in this particular case, this is a Bitcoin trade. The market fell down a long way. So in this particular trade, here's a gold trade where the market rallied a long way. And then finally here, another Bitcoin trade. Here we have price fell a long way. And so the very first thing that jumps out to us should be, what's a natural retracement? Just, all things aside, what ought to happen in very normal circumstances? And that's this concept of the 50% rule. We can attribute it to guys like W.D. Gann, but in essence, it's just a very simple law of nature that usually what goes down must bounce at least 50% of its previous move. It's a time-tested rule, and it is one of the very first technical rules that I ever learned in trading. Guy I used to trade commodities with years and years and years ago, Ken Roberts. Maybe some of my students will remember him. The point is that this 50% level, in this case the bounce, in this case pullback, and in this case bounce, this is a very natural, normal thing for price to do. And if we can use that as sort of our target, then that becomes a very realistic objective. Nothing out of the ordinary, just business as usual. Now what we really want to do is we want to try and find a situation where price maybe is telling us that, hey, instead of going down, I actually want to start going up. And I would argue that there's really sort of 2 or 3 ways that we can find that. The first, of course, we're just really simply put, is to hunt for trade location where maybe, in this case, it's a bull bounce. Maybe there's structural reasons why price should reverse here. That's perfectly fine. In this case, if I'm not mistaken, this was off a higher time frame, 38.2, like off of the weekly charts. And it was at the time it was talked about quite a bit. Big brokerage houses like Goldman Sachs had suggested to their clients that they really watch this level. So, really what we're looking for is there a realistic reason for us, and I think this is probably the best example, for us to actually look for some sort of pivot, good old reload zones. In this particular case, we don't even see what the bottom of the range is here. But you can see price had taken back even what you see on the screen here, a good chunk of that rally. So, trade location, I always encourage, really, and I would argue this is probably the best example. Trade location is always, reason number 1 for us to consider, actually taking that trade. Reason number 2, actually, here's not a bad breakdown here visually for you, right? Acceptable trade location. As I had said here before, this happened to be a higher time frame, 38.2. It was also the end of a bearish AB equals CD harmonic objective. So there were higher time frame reasons for trade location here. If anything, I think this is probably a perfect example of trade location. But reason number 2, I always encourage people, and this is, again, thinking along this lines, Hollywood Nick or El Tangonator. I really would like to see some sort of signs of divergence. In this particular case, nice bullish divergence where the indicator itself was making higher highs and higher lows, even though price was making lower highs and lower lows. In this particular case, I think we also even had a volume divergence. Super, super powerful. In this particular case, you can really see the push higher into this shorting zone was definitely on a weakening momentum in price itself. I really like using the MACD histogram as sort of a raw momentum push. So reason number 2 is, in essence, what we want to see is some sort of divergence in our momentum indicators. I even really like just this even tight little m right in here, which is sort of like a double divergence, because you get a nice little divergence that develops off of this move, coupled with this bigger divergence that still at this point is potential, but nonetheless, with this little divergence confirmed, going to give a lot of ammunition to this thing breaking down. As I said a moment ago, this was just an absolutely beautiful textbook setup of this, where we had, in essence, our overbought, oversold indicator, our heavily modified Williams percentage R, giving us signals that this market was pretty washed out. Nice divergence here in this indicator. In the oscillator, nice divergence. You can see the higher highs and higher lows in the on-balance volume. I often tell people divergences in the on-balance volume, oh boy, super powerful. In this particular case, I really liked this double divergence in MACD. It's a fantastic example. So that's sort of your reason number two. There's an airplane flying overhead. Good timing. And then finally, reason number three. I really like, especially for these Hollywood Nick and the El Tangonator. I really like if we can get a oscillator that's flashing oversold. That's awesome. But in essence, reason number three, even with our MACD momentum indicator looking like this, I can now start hunting for structural reasons. What is there structurally in price that will sort of support my trade idea? In this particular case, as we said, this is a fractal. We'll learn, take the candlesticks tutorial in here, looking at price analysis tool. Just go and watch this stuff. We can learn about structural signals. What do structural changes in price look like? This particular one here, this is a really nice little fractal example. It's a tough trade for new traders to take. But as you can see, at this point, I'm simply going to ask what is the risk matrix on the fractal trade. And in essence, I'm going to go short on a break of this low with my stop above the shooting stars high. And at this point, really, what I want to do is I want to think back to where that 50% rule was, and that's going to be my objective. Really, the long and short of it here is, and I encourage new traders to go through this whole process of finding the setups. And if you've done this math and this number comes out to below 2 to 1, maybe, give that trade maybe a pass. Maybe paper trade that trade. I really like that if we're going to actually risk our money in the marketplace, that we get paid for our efforts. I think a good rule of thumb, and really what separates a lot of El Tangonator potential ones from ones that I just simply don't talk about, or Hollywood Nicks, is just simply that the risk taken on whatever structural pattern I'm going to take is less than 2 to 1. And it often makes me just say, I think I'll pass. In this particular case, nice 3 to 1. And hopefully you can see the trade basically fired. Took a little bit of heat, no doubt about it. Keep in mind, this is a trader's life. You get paid to worry. Price then started working in your favor. And, within a week or so, boom, you had your objective hit off of the daily charts. In this particular case, off a 2-hour chart, we could have hunted the fractal. Bit of a tough trade because this bar of the fractal was just this funny little doji. I think, if anything, in this particular case, really good example of a nice W in market structure to help you frame the trade. You're going to simply buy on a break of this high. And if I risk down to a break of this low, do I get at least a 2 to 1 risk reward if the 50% level is traded to? And the answer here is yes. So in essence, wait for a big move in price. Draw your 50% rules. Then start hunting for signs of divergence. And double divergences, que bella. then wait for some sort of structure to frame your risk on the trade. Go and grab your little risk matrix tool, right, on things like TradingView. It's just over here. I think it's one of these selections, long position, short position. When you pull up your chart, and it doesn't really matter, in this particular case, a short off of this fractal top with this nice double divergence, 50% level, greater than 2 to 1. Trader's got to take a trade. It's as simple as that. And that is basically the Hollywood Nick, or if you want to call it the Tangonator setup. And for whatever it's worth, Tangonator himself ran this setup through the winter of 2017. I think he said he booked about 40 some odd trades with a 75% success rate of hitting his 2 to 1 objective. So that's affectionately why I gave it his name. This gentleman put the time and effort into learning the setup. And I think psychologically he now believes in it, and he's got this tool now to basically go out and make money trading in the marketplace for the rest of his life. So hope that helps you understand that setup, and I'll throw this on the setups menu there so you can watch this video back anytime you need to. Thanks a lot, and bye for now.